In this video, we're going to take a look at the 7 best breakout and pullback strategies, tools, indicators, tips on how to improve your pullback and breakout trading. So without wasting any more time, let's just get into the video. The first one is called the central pivot point rejection. And I saw all your comments underneath my last video where I started introducing this concept. So let's start getting into this over the next few videos a little bit more. So in a trend, and by the way, I've turned on the weekly pivot points, and I will show you in a moment how to activate this in your trading view. And in a trending structure, what you will often see is that in a downtrend, the market will trade underneath and reject central pivot points from underneath. In an uptrend, you will often see that the market uses pivot points as support. So the market is trading above them, retesting and as support, and then continuing higher. So that's a very important feature, and you will often be able to see that. Also, what you see here is that I have included the moving average from the 4-hour chart, 50 period moving average, SMA. I will also show you exactly how to set up this chart in your trading view in just a moment. So what are we going to do here? First of all, we see that the market is going from trading here above the moving average, also above the pivot point, to first of all dipping below the higher time frame moving average, and then using the higher time frame moving average as resistance and rejecting the pivot points from underneath. So when we zoom in, this can be a trading strategy in and of itself. You wait for the market to trade above the central pivot point. You want to make sure that you stay below the moving average, and then on a breakout, a rejection underneath the central pivot points, you could either use general support and resistance, breakout strategies, just wait for a flag pattern, any other pattern that you can find, and use it then to fine-tune your trading. And this could be the basis of your trading strategy. Another example, here we have the higher time frame moving average. You can see the market is trading into the central pivot points from underneath, rejecting them, and then trading higher. And this happens time and time again. Obviously, the prerequisite number one is that you are in a trending market. So this will only work in a trending market, just like any other moving average will only work in a trending market. But this has to be clear. And what you can then just do is wait for the market to get into those levels, then drop to a lower time frame maybe, wait for a breakout, break and retest, look for patterns, and use that as a foundation to build a strategy. All right, so now we are in TradingView, and I just released a huge TradingView tutorial, 50 minutes, and I show you every little button, everything in TradingView. If you are interested in that, make sure to check that in my latest videos. But to set up your charts like mine, first of all, we go to indicator, and here you can just start typing in pivot, P-I-V-O-T, and then we just select standard. And then you can see this is what we have here, and then we just click on the settings symbol. And what I typically do is turn off all the S and R levels. We only need the central pivot point. We can use it black for now. And what I do is I use the weekly. And then you can see we have our weekly pivot points. The rest you can just leave it as it is. And now you can see this resembles the weekly pivot points. Every week you get a new pivot point, and you can start observing it. It's a very, very good, helpful indicator. Then how do we get a higher time frame moving average on our charts? Again, we go to indicator, and here it's even enough if you type in MA, and TradingView knows that you're looking for a moving average. So we can just click on it, and by default you get a 9 period. Again, we open the settings, and first of all, under time frame, if we want to get a daily moving average, we use here the option under time frame day, or if you are on the lower time frame, choose maybe 4 hour. Then we change it to 50, and then we have a 50 period moving average from the 4 hour. Under style, you can obviously then change how it looks. And that is then how you could set up charts, exactly like what I've shown you in the previous strategy idea. Next, let's take a look at breakout liquidity and a pullback approach. So what do we have? We have a classic move higher, then we have a head and shoulders pattern, a breakout, and a move back. And this is something where a lot of traders struggle. By the way, I just used this as another example, but it's always good to repeat the basics. So a lot of traders I see have a lot of problems with breakouts, and they often say that their brokers hunting their stop and breakouts just don't work. However, what really happens is very interesting actually. So a lot of traders are able to identify the head and shoulders, they get in on the breakout. Here is probably the breakout entry. Then the market moves in their favor, everybody's happy. And initially their stop loss is here probably, or maybe above the high. And then as the market moves away, they will move their stop loss to break even somewhere around here probably, if they use a pending breakout strategy, their stop loss is going to be right here. And this is just so common that you will see everybody is happy and then the market is going against them and really hunting the stop loss. It's not your broker hunting the stop. There's no other thing going on. It's just that everybody knows that here is your stop loss because you just moved it to break even. And then the market moves into the stop loss zone and goes lower. And it can be a strategy in and of itself, a breakout and a pullback approach. Obviously, if you're waiting for a pullback approach, not always will you get a pullback. So this is the downside of being a pullback trader, is that if the breakout occurs and there's no pullback, you're just going to miss a portion of the trade or the whole trade. But on the other hand, you cannot catch every single move, and you have to be okay with understanding my edge is a pullback strategy, and if there's no pullback, I just don't have an edge. And then you can see the market after breaking the pattern, which could be considered a triangle or a flag, whatever, the market is continuing. And we see that time and time again. Here, another example. We've just talked about distribution accumulation. We go from uptrend to distribution, have support level, the breakout occurs here, the market moves in your favor, your stop loss is pulled to break even, the market goes back into the zone, breaks above the zone a little bit, and then here you can see this is one of my favorite price action patterns. We have a strong momentum candle, we have a deceleration candle, which can be a doji or a pin bar, like in this case, or somewhere in between probably, and then a strong bearish candle. So this candle in and of itself can be then your signal to drop to a lower time frame. Here you can see this is what it looks like on the 1 hour chart, and then this pattern on the 5 minute looks like this. Again, this is the fractal nature of the markets. A head and shoulders on a lower time frame will often look something like that on the lower time frame. So very on a higher time frame, and then on a lower time frame will look like that. So it's really interesting how lower and higher time frames work together. We have a divergence, we have a nice support level, we are back in the stop loss zone, and then on the breakout you could see the market is then unfolding. So again, I love this combination of the fractal higher and the lower time frame. A nice 3 candlestick pattern on the higher time frame at the right support level, at the right distribution zone, and then dropping on the lower time frame, timing it with a breakout approach, a break and pullback. It can be already the basis of a great strategy, so really start paying attention to it. Another example, even here on the very exotic pairs, US dollar, Russian ruble, 1 hour chart. We go from uptrend, divergence, distribution, breakout, people move their stop loss to break even, grabbing the stop loss here with a fake out, with liquidity trap, whatever you want to call it. We draw a support level here, we wait for the market to get out of it, and the trend continues. In general, Elliott wave theory, this would be considered a wave 3 trade. Wave 1 is typically the wave outside of the pattern, the breakout into a new trend. Wave 2 in this case is a sideways range, and wave 3 is then the continuation. Generally, most traders are probably gravitating towards wave 3, which is usually the highest probability trending wave. Wave 1 is too early because we have no idea yet if the market is really reversing, and wave 5 is then a little bit of a late continuation. So wave 3 is really interesting. Now we have our Ichimoku cloud rejection, and for that we're just going to simply use Ichimoku cloud. I have hidden the leading, the lagging span and everything else, and we're just looking at the cloud here. And I just used the basic settings, default 9, 26, 52, 26. So a very, very basic Ichimoku cloud. And what you will see is very similar to a moving average, is that very often the market pulls back into those clouds and uses that as a resistance in a downtrend and support in an uptrend. The way or the reason why a cloud may be a little bit better than just a simple moving average or a single moving average is that a cloud provides you a little bit of a wider corridor, and price action or price in general is very dynamic. There's a lot of volatility, and often the market is overshooting or coming short of a moving average. So having this little bit wider range of the Ichimoku cloud may actually be more helpful because you can catch potential pullbacks much earlier. You can see zooming out, you can see there are lots of times when the market is coming back into the moving into the Ichimoku cloud, and then finding resistance in this case. And this is something that I really highly recommend. And the way you would be using it is either on a multi-time frame approach. So every time you can see the market dips into such an area and shows you deceleration, you drop to a lower time frame and you look for a pattern. Even on this time frame, right away, you could see that there are just support and resistance, breakout, back and forth, trend lines that could be used for breakout or entry timing. So there are options, and I just want to highlight the importance of having this indicator. It's really, really great. It's very effective, and you can use it across all the different time frames. Now we're going to take a look at a double overbought reversal. What does this mean? So we are using the RSI 14 periods, and we're having two. So the first one is the one from this time frame. So we are on the 1 hour chart. This is the 1 hour RSI. If you add the RSI to your charts, it's always defaulting to the current time frame. Then we have the RSI from the 4 hour time frame, also 14 periods. So we have a current time frame and a higher time frame RSI. And what you will often see, not always, nothing works 100%, is that if both of those RSIs are in overbought or both are in oversold, very often you're looking at a potential reversal. So here, for example, we are in overbought. We are in overbought on the higher time frame, and the market is reversing. Here as well, both are in overbought, the market is reversing. We have a very nice distribution pattern. Here we have both in oversold, the market is reversing. So this could be a starting place. Obviously, I wouldn't recommend to just use the RSI and alone. And then as soon as they are both in overbought, go short or go against it. That would be a little bit too basic and probably not robust enough. But this could be a first starting point. Whenever you see both in overbought, oversold, you could, for example, also add the criteria of a divergence. Like here, you have both RSIs show you a divergence, 4 hour and 1 hour. And that you could use for the basis of a strategy as well. So this could be a great filter. So higher time frame divergence, lower time frame divergence, both are in overbought area, and then afterwards the reversal comes. So I will show you how to set this up in TradingView. Again, we go to indicator and type in RSI, and we're going to add it. And first of all, TradingView has added a lot of stuff to the RSI, so we can delete everything except for the RSI. I make it a little bit thicker so that it stands out, and then we have a general RSI. We should add the higher and the lower band, so we know where overbought and oversold is. And now a trick is we go to the dots, we go to copy, then on our keyboard we hold Control and V, and now we have two RSI. So this is the current time frame RSI, and here we want to have the higher time frame. So we open the settings, we go to inputs, we go to chart or time frame, and then here we're going to add the 4 hour. So what you see is now we're on the 2 hour, and you can see this is now the 1 hour time frame, and this stays the 4 hour. So on whatever time frame you are, the lower one is always going to be your 4 hour RSI, and then you can start using it, and you can see right away there are things jumping at us, both in oversold, overbought area, and then we could start using it as a filter. So have fun with it, play around with it, and let me know in the comments how you like this approach. I really like the Bollinger Bands, and we can use Bollinger Bands in many different areas and ways, and they're very versatile. So let's take a look at a chart. And what do we have? We have, again, our higher time frame moving average. So we are on the 1 hour time frame, as it says here. And the moving average is coming from the 4 hour, 240 minutes, 4 hour, this line. And we have the regular Bollinger Bands, 20 periods, 2 standard deviations. So technically, first of all, we use the moving average to help us identify support, resistance, and trends. So as long as the market is below the moving average, we are in a downtrend, and we only want to look for downtrending short scenarios. And what you can then look for is moves into the Bollinger Bands. So we want to look for moves into the upper Bollinger Bands, especially because they can be the starting point of rejections. Here the market didn't make it into the Bollinger Band, so nothing happened here. Here the market moved into the Bollinger Band, rejected it. Here as well, moved into it and rejected it. And those can often be your continuation signals. If the market in a downtrend below the moving average is making it into the into the upper Bollinger Band and rejecting it, they can often be the starting point of a strategy. So when the market rejects such a Bollinger Band, you would then look for a continuation trade. Here as well, we are in an uptrend. And in this uptrend, when the market is above the higher time frame moving average, we want to look for times when the market is spiking and rejecting the Bollinger Bands at the downside, because we want to trade long, we want to go with the trend. So at this point, we always want to look for continuations away from the outer Bollinger Bands. Obviously, it will not work 100% of the time, but this can be a great starting place for multi-time frame strategy. So set up the charts like this, and then when the market spikes into such a Bollinger Band, drop to a lower time frame, you could go all the way to the 5-minute when you see something like that, and then use it as a day trading strategy, or at least the foundation. Now we're going to take a look at the Fibonacci retracement, but also we're going to start putting things together in a meaningful context. So everything that we have learned, we start to now combining it. So what we have, we draw our Fibonacci from the high point of a trend to a low point of a trend. And then you can see the market gives us retracement levels. We have 76.4, which I would generally ignore for pullback trades. It's too close to the initial turning point or the end point of this initial wave. And generally what you want to focus on is 61.8 or 50. Those have the highest probability of showing you a reversal. 38.2 is also still a good choice. So those three are typically the ones where you want to look for rejections or reversals. Here you can see when we zoom in, I have marked those zones. We can zoom in on those, and those are great starting points for reversal trades, and you can often use them for nice breakout, pullback approaches, break and retest strategies, and they work really, really well. You can see we're on the 5-minute now, coming from the 1-hour Fibonacci retracements, and you can see that those patterns work very nicely around Fibonacci retracements. Here another example, in this case an uptrend. We have the starting point of our trend wave here, we have the end point here, so we draw our Fibonacci from here to here, and then you can see 38, we have a very nice double bottom, and we can wait all the way for the market to show us some pattern on the Fibonacci retracement. Just because the market is hitting the 50, it doesn't mean you should automatically go long. Wait for some signs that the market is slowing down. Again, we could add the central pivot points. Wait for the market to trade back above the central pivot point, and then look for a trade entry, for example. There are many, many options. Again, downtrend, you can see the market is giving you here a 61.8 retracement with a fake out. Remember what we did in the last video about accumulation and distribution, also resistance shifting. This is what you can see here. We have initial move, then here we have a fake out, and the market is moving lower. We can use the moving average as an additional filter as well. We could add the Ichimoku cloud, so we draw our Fibonacci from here to here. We see that we are still in the Ichimoku cloud. If, for example, the market would be overshooting the Ichimoku cloud, that would be not a good sign, but as long as the market is still within the Ichimoku cloud, this is a good place to look for a pullback. And you can see zooming out, this is what happened afterwards. We have the fake out. Here's where you have the deceleration, and then you have the continuation. So wave 1 is typically where you draw your Fibonacci, point A to point B, and the initial wave 1. Then the Fibonacci retracement helps you to find the wave 2. So this is wave 2, and then when the market exits wave 2, this is wave 3. As I keep saying, wave 3 is typically the highest probability trending wave, depending or based on Elliott wave theory. Last but certainly not least, we have round number rejections, and I will show you how to create some really interesting studies with that. So I have just activated the round numbers in TradingView, and you can see now we have those green dotted lines at every round number. 153, 153.5, 154, 154.5, and so on. And you can always and often, not always, but often see that the market is really nicely paying attention, especially to the big round numbers, 153, 154, here 155.5, 156, and so on. So this could be a great foundation for a trading strategy, or at least you can use it as additional confluence for support and resistance. And again, use, for example, the central pivot points. If you see that a central pivot point is very close or right at a previous round number, that could help you identify objectively support and resistance levels. And then again, how you would use it is just generally, again, break and retest, pullback strategies, and breakout approaches. So let me know in the comments which you like the most, which you find more interesting, and then I will make a dedicated video about one of those concepts in one of my next videos.